Good morning. Today, our team will present the performance analysis of Radiant Go Studio by comparing the budget with the actual. We will begin by presenting the cash budget. This slide shows an overview of the cash budget for each quarter, comparing the total cash available and total cash disbursement. The net cash flow is heightened in quarter 2, while losses occur in the quarter 4. Despite the investment and financial obligation, this company is still able to maintain strong liquidity.
Gross profit margin remains stable at around 33 to 35%, while cost of goods sold accounts for about 65 to 67% of revenue, indicating consistent production cost control. Operating profit margin ranges around 13 to 16%, while S&A expenses stay between 17 to 20% of revenue, reflecting relatively stable operating cost management. Total revenue was about $1.38 million, with positive net income in every quarter. Quarter 4 recorded the highest profit due to higher sales, resulting in an annual net income of around $158,000, reflecting effective cost control. Overall, the company has a strong financial structure with good liquidity, low liabilities, and a solid equity base, supporting future growth. As of year-end, the company reports total assets of about $553,000 and liabilities of $142,000. Long-term debt stands at $80,000, reduced from $180,000 after $100,000 repayment, while equity is around $411,000, indicating a low debt structure and capacity for future investment.
Next, I will explain the revenue variance analysis. For the standard collection, the selling price variance is $7,320 unfavorable, which means the actual selling price is lower than expected. The sale volume variance is $5,400 unfavorable, meaning fewer units were sold than planned. For the signature blend, the selling price variance is $7,950 favorable, which means the product was sold at a higher price than expected. In addition, the sale volume variance is $16,250 favorable, meaning the number of units sold was higher than planned. Overall, both price change and sale volume positively affect the company revenue performance.
Moving to our direct cost variance for the standard collection. We have finished the period with a net favorable variance of $14,630. While our bottom line is healthy, there is still a challenge in rising material costs. On the material side, we saw a $5,660 unfavorable variance driven almost entirely by a $5,035 deficit in soy wax. We are facing a double hit here. Market prices rose to $18.85 against a $16 budget, and our consumption per unit was higher than planned. We also saw a minor price creep in our jars. Only our fragrance oils came in near budget, thanks to a slightly better purchasing rate. The reason we're still in the green is our direct labor, which delivered a massive $20,290 favorable variance. This was driven by two factors. First, a lower than expected average hourly rate, and second, an efficiency variance of $12,450, meaning our production team significantly outperformed the standard hours per unit targets. In summary, our production efficiency is currently subsidizing our supply chain's price increases, and my immediate focus is to renegotiate the soy wax contracts to stabilize prices while we investigate if these labor efficiency gains are sustainable or not.
Now, I will briefly present the direct cost variance for our signature brand product. First, Premium Beeswax Blend show a mixed result with an unfavorable price variance but a favorable quantity variance, indicating that the material cost was higher than expected, although the production used material efficiently. Next, Geometric Custom Jar show an overall favorable variance, mainly because the production team used fewer jars than the standard level. For fragrance oil, the result is also favorable overall, as the company was able to obtain the lower purchasing cost, even though the usage was slightly higher than the expected. However, direct labor was unfavorable variance due to higher labor rates and lower efficiency during production. In conclusion, although Most material variants are favorable. The unfavorable labor performance result in an overall slightly unfavorable outcome for signature blend.
After we have seen all budgets and variances, I will present the three most concerning variances and explain why. In this analysis, we use two perspectives to evaluate variances. First, dollar impact, which shows financial effects on profit, and percentage variance, which help identify efficiencies problem and severity on deviations. The primary basis is the dollar impact because managerial decisions are ultimately financial. A larger unfavorable dollar variance directly reduces profit. However, percentage variance is also useful too because it allows us to compare a different size of item, identify operational inefficiencies, and detect unrealistic standards. Therefore, both measures are considered when determining which variances are the most critical. Based on these criteria, we identify three key variances that need management attention. This table summarizes the three most concerning variances. First, standard collection revenues indicates a weaker than expected sales performances. Second, standard soy wax indicates a major cost control issues in primary raw material. And third, signature blend direct labor, such as a potential labor cost inefficiencies. Although the labor variance is smaller, it is still important because it affects the premium product line, which is expected to have a higher margins. Based on both financial impacts and operational significances, we prioritize the variances as follows. The higher priority is the standard soy wax, which represents a structural cost risk. Since wax is a core material used in every single candle, higher costs directly increase in cost per unit, compress profit margin, and reduce pricing flexibility. The second priority is the standard collection revenue, which represents market risk, lower sales volume, and price reduction, reduce in contribution margins, lead to underutilizations, production and capacity, and increased pressure on overall profitability. The third priority is signature blend labor, which represents an operational risk. A higher labor cost increase in the unit production cost of the premium product line and may reduce its scalability if the demand continues to grow.
First of all, looking at the standard soy wax variance, what stands out is that both the price and quantity variances are unfavorable, which suggests the issue comes from both supplier pricing and internal production efficiency. On the cost side, not having long-term contracts may lead to higher wax prices, and on the production side, small inefficiencies like material waste can also increase wax usage per candle. To address this, the company could improve procurement strategies and tighten production control to stabilize cost. Since soy wax is a core input in candle production, even small cost changes can significantly affect profitability. Next, for the revenue variance, the main issue is lower sales volume and a slightly lower selling price than expected. This may reflect stronger competition or weaker performance in some sales channel, so analyzing channel performance could help identify where the gap comes from. However, it's also important to be careful with pricing because sustained price reductions could weaken the brand's position in the mid-market segment.
For direct labor in the signature blend product, the variance is unfavorable due to both rate and efficiency factors. The rate variance may result from overtime or higher skilled labor than planned, while the efficiency variance suggests that production required more labor hours. To improve performance, management should review workflow scheduling and improve workflow efficiency. For the standard jar, the total variance is $766 unfavorable, mainly caused by the price variance of $591 and the quantity variance of $175. This means the company paid more for the jars and also used slightly more than expected. This may be related to the supplier pricing changes or material handling issues such as breakage or waste. To address this, the company should review supplier agreements and improve storage and handling processes to reduce unnecessary costs.
In conclusion, the most critical issue structurally is standard soy wax inefficiencies. The most strategic issue is revenue shortfall, and growing operational issues is signature labor cost control. If I will present to the owners, our biggest threat is core material costs and inefficiencies. If we don't correct this, growth will amplify margins erosions. Sales will recoverable through strategies, and labor inefficiencies are controllable through management improvements.
Thank you for listening.